Hi, everyone. Welcome to YX Insights webinar today. Today is September 3rd, just after the market closed. So today we're going to run through quite a lot of things, actually. First, a lot of the macro data ahead of the non-farm payrolls. And then secondly, we're going to talk about what we should expect, both in terms of seasonality and after the first Fed cuts in September. And then in the third section, as usual, we're going to go through some live trade setups. And I hope everyone's had fun already with NVIDIA today. And we'll walk through NVIDIA as well. All right, let's get started. So going through the data, GDP first. In the second quarter, GDP went up 3% quarter on quarter at an annualized rate. So that's an accelerated pace than Q1, which is 1.4%. It's still slower than what you saw last year, at the end of last year in Q3 and Q4, but pretty much the economy is still robust. There is no sign of recession yet. I know we're going to talk about recession later on in this webinar, but from the evidence of the economy, we're not seeing anything yet. So this is why the Fed thinks this time is different, despite the fact that we have multiple economic indicators suggesting we might be having recession, such as the sum rule, as well as the yield curve inversion. And just to break down the components of GDP, GDP went up quite a bit because of increased consumptions, both in goods and services, as well as private domestic investments. There was a net imports in this previous quarter, as well as Q1, which dragged down the GDP. But there was also an increase in the government consumption as well. So across the board, everything looks pretty good except for the imports. So again, the whole picture looks pretty good for the economy so far. Looking at the corporate profits, we had a negative quarter-on-quarter growth last in Q1, and in Q2 we had a positive growth this time. Actually, 1.7 doesn't sound a lot, but it's actually significantly higher than what we had this time last year. So again, the corporate profits and this GDP seem to suggest that economy is doing pretty well, and the stock market strength is warranted. We had the headline PCE and the core PCE at the back end of last week. They both came in flat on a year-on-year basis compared to June, but like this, we are still sort of ahead of the Fed's expectation earlier in the year. So it's still pretty good at the moment. I think the Fed doesn't really see 2% this year anyway, but we're still on track in terms of the overall trend. On the 3-month annualized rate, this is where it gets really interesting. So all this is saying is that if we take the month-on-month PCE change for the past 3 months and extrapolate for the whole year, what does that look like? And actually, core PCE already looks like in line with the Fed target, and the headline PCE is below the target already at 1.2%. And if you look at this trend from March onwards, so between December and March, the Fed thought inflation's resurgent again, and then between March and last month, the Fed thinks that we're on track and we should start cutting rates. So it's a quite big change from earlier in the year. And I think the potential downside is that in the coming months, after the non-farm payroll, we're going to get CPI data and then PCE data at the end of the month. We could see this heading further towards 0%, which suggests the Fed might have done too much and therefore they should cut more than already priced in, which is 100 basis points for 2024. And just to break down a little bit, again, it looks quite flat here because of the scale, but so food and energy goods and services are basically on target. Core PCE is 2.3%, 2.6%, I think, from the previous slide. Yeah, 2.6%, so which is what we expected already. And services PCE is still slightly hot. So goods PCE is essentially deflationary or disinflationary neutral territory, but service PCE 3.7%, still on the overall downtrend from the beginning of the year, still slightly hotter than what the Fed wants. So, but as long as this still nicely trending down, it's not a big problem at the moment. So looking ahead to non-farm payroll on Friday, all right. So the non-farm payrolls are actually quite difficult to predict. I've tried a lot of different correlations, etc. What's really important on Friday is the unemployment rate, which is 4.3% in the last report. And that is significantly higher than what we had last year, which basically is what triggered the recessionary concerns by the market at the beginning of August. So what correlated the best with unemployment rate is the changes in initial claims, initial jobless claims. And the good thing is we get initial jobless claims of the month. We got that data already for August. So we're slightly ahead of the non-farm payrolls. The bad thing is that while it correlates very often, it doesn't always work. So you can see here, like here, initial claims and unemployment rate both dipped here, rose here, dipped here. Pretty nice trend. But there are some months like here in November, again in this is in March, and also last month where initial claims went down and unemployment rate went up. And I think a lot of this discrepancy is driven by the immigrant workers, which now accounts for nearly a fifth of the overall participation of the US labor force. So, so what the graph suggests is that unemployment should actually be at least flat or even going down, which is good for the Fed because they don't want labor market to soften. But we might not always get this because of the discrepancy we see here in certain months. So on the balance, I would lean towards unemployment rate staying either at 4.3% or even coming tighter, 4.2. It could come in tighter. It could go up to worse if there's more people coming into the labor force, so high participation rate, but not as many of them finding new jobs. Or it could come down if obviously people getting new jobs, or people finding more part-time jobs, so juggling multiple jobs, and because but actually the household data may already reflect that as well. But so there's a lot of different dynamics coming into this report, and the market seems to be hinged on this. Whether if we have 4.4% unemployment rate, we should see 50 basis point cut in September. Or if we see 4.3 or 4.2%, we should see 25 basis point, which is the base case scenario by the market. So at the moment, I'm leaning towards 25 basis point because of this, but there's no guarantee. And it's always been a little bit of a headache trying to predict non-farm payrolls, actually. And also, I actually want to make a point, which is that maybe sometimes we do predict the right direction, but what we've seen is that the government releases very strong non-farm payroll data, which gets revised down in the next subsequent payrolls report. So last month we saw that. Last year we had up until March this year, the total number of jobs reported was actually over nearly 1 million, or it was 800,000 higher than the actual jobs. So there's a lot of inflationary job reporting going on, which always makes me a little bit skeptical of the overall reports. But that's the challenge we face. And I think the Fed is none the wiser either. And unfortunately, they're going by report. And they just have to make really important decisions on bad quality data. That's the stakes we have. So any questions so far? Just unmute yourself and shout up to this point.
Hey, this is
Yeah.
Boss. I have a question to understand payroll
Sorry,
hard to
uh,
predict. Can you hear me?
sorry, I can't quite hear you that well. Do you mind typing in chat or just repeating the question? Yeah. If you type in the chat, I can also answer the question. That's also fine.
Can you hear me now? Is that better or no?
It's a bit fuzzy, I would say.
Okay. All right. I'll come back.
Okay, if you type in the question, I can always catch a break and answer it in the chat. Okay. All right. If anyone have any questions from here? So that was quite a quick section, actually.
How about now, Eamon? Can you hear me?
Oh, yes, I can. Yeah, go on. Yeah, go on.
All right. My question is, so understand predicting the non-farm payroll is challenging. My
Yeah,
my question is more around um, what can we expect if we see payroll coming in line with the like three possible scenarios, coming in line with
yeah,
expectation, better than expectation, worse than expectation. So what can we expect in each of those scenarios? I think the Fed, in terms of the rate cut, based on everything we have heard, everything you have shared or Alex shared, the Fed is kind of thinking about not going too aggressive, right? That's not favorable for them. Fed wants to stay the course, manage the narrative, cut gradually as opposed to going what you just
yeah,
mentioned, 100 bips. That's gonna be a big signal that okay, something is not right, and we have broke everything, and soft landing is not on the table anymore.
yeah. So I think so. If unemployment rate shoots above expectation, let's say 4.4%, what we're going to have essentially is the market will price 50 basis point after 50 basis points cut in September and November. So yields should come significantly lower. And I think we'll just basically have the repeat scenario of August, beginning of August. But if it comes in line, I think you're absolutely right. So the Fed's default stance is that they don't really want to go too fast. Um, uh, and their preference is to do 25 basis points. They can do it maybe twice or three times this year.
Mm-hmm.
But they are not that keen to do 50 basis point cuts. But right now, the market has priced in at least one of the meetings between now and end of the year to have 50 basis point cuts. So basically, the market's at least 25 basis percent at least 25 basis points higher than what it would be if the employment rate comes in line, essentially. So we'll have to price away those 25 basis points. I don't think so. If non-farm payroll comes in better than expected, I don't think it would drastically change the expectation of 75 basis point cuts. The Fed might try to push back on 75 basis points as well. And I think a lot of that is to do with the fact that in June, they wrote down the median dot plot to be just one cut for this year. So going from 1 to 3 is still quite a stretch. Going from one cut to 100 basis point is a massive stretch. Going from 1 to 3 is still a stretch. I think going from 1 to 2 is kind of okay. So the Fed will, I think there will be a tug of war between the Fed and the market on whether we should have 50 basis point cut in the between now and the end of the year, and or 75 basis points. So I think if the market, if data comes between better than expected, then there will be a tug of war between those two scenarios. If it comes in line, then I think 70 basis point will be priced in. And if it comes worse, then I can see definitely 125 basis point or 150 even between now and the year end. So that's how I would kind of think about the Friday's report. But most importantly, the Friday report has the biggest impact on the upcoming meeting, which is September, on the September 18th. And right now, the market price is about 33 basis points of cuts. which translates to about 40% chance of 30% chance of a 50 basis point cut versus 25 basis point cut. So I think that one's the most important, because even the Fed cuts 50 basis point, they can always say we're going to be data independent. We're not going to do 50 basis point every time. We'll treat the data as they come in anyway.
Mm-hmm.
So I wouldn't. So I think there'll be market volatility around that, but I wouldn't say September non-farm payroll is end or be all either between now and year end. Yeah. Does that help? Yeah.
Yeah, it helps. I'm just thinking in terms of the trade, like what is or investment, what is the right course of action? So sounds like based on what you just mentioned, it is ideal to get, like the ideal scenario would be get everything according to expectation, not too far from expectation, either up or down, right?
Yeah.
That is ideal scenario. One of the things that you mentioned about the claim, there was that issue in Texas where a lot of people were out of work due to the natural disaster, but I think a lot of people are back to work now.
Yeah.
So that may neutralize some of the decline we have seen in the earlier months. But I'm just thinking, does it make sense to hold treasuries while Fed is cutting the rate, or is it? I know earlier you shared some graphs, so that's basically what I'm just thinking. What would be the right course of action when it comes to investments or trades, given what the report shows and what we can expect the Fed to do based on the report.
I think we can. There's a few more graphs I want to show, a few more charts I want to show in later in this webinar, and then we can talk about the TLH and TLT setups at the moment, and how we should think about that. Yeah. Cool.
Thank you, man.
All right. So non-farm payrolls, big factor upcoming Friday on where the yields might go. And coming to this chart, I've flagged this in the last week as well. So this is the Fed liquidity versus SPY, or S&P 500 ETF. I've also got the chart for 10-year bond yields as well. So the second piece of the puzzle is the liquidity. What we saw is, so essentially this chart, for those who are new to the webinar, represents liquidity in the system, as it were. So the Fed's balance sheet minus the Treasury general account, which is the Treasury's bank balance with the Fed, minus the reverse repo, which is how much money markets are lending to the Fed, plus the banking term funding program, which is the money that was created, the pot that was created to help regional banks recover deposits, to guarantee depositors when Silicon Valley Bank defaulted. So this is the formula we're using to gauge the liquidity in the system. Essentially, the higher this number, the more liquidity there is in the system. For example, doing QT, quantity tightening, would reduce this number, all right? Treasury issuing more debt would reduce this number. Would reduce this number because TGA would go up. Reverse repo levels go up, would reduce this number because the people, money markets are lending more money to the Fed rather than investing in the Treasury market, etc., etc. So we can see a pretty strong correlation up until beginning of the year. Actually, until mid-year, essentially. It diverged from here onwards, and the market still went up. Liquidity went poor, but it corrected with the carry trade unwind, which was from beginning of July. And now we seem to be back up in terms of the correlation again. What we've noticed is that at the end of last month, which is at the end of August, liquidity had dropped, especially in the final week. And we saw equities also drop with it. And actually, when I look at the 10-year Treasury yield, usually they have the reverse correlation because worse liquidity means high yield, and better liquidity means lower cost of borrowing, right? So again, the liquidity dropped in the last week, and yields went up. This is just 1 week, but it's quite telling. So this is another thing we need to think about in terms of yield. So we have the non-farm payroll, which is the fundamentals, and then we have the liquidity chart, which is suggesting this is pointing down, and the yields might be going back up and back up. So there's another dangerous sign for yields to go higher. And I'm just comparing this with the yen carry trade, which is the SPY versus the dollar 10-year Treasury and the yen 10-year Treasury spread. So literally the dollar yield minus the yen yield. And this is the carry trade unwind. As you can see, equities moved in line with this spread. Lower spread means people are unwinding their risk positions in equities and in the US, and they're moving money back into Japan as Japan raises interest rates. So, but since that episode of crash, most of the carry trade have been unwound, and we saw a decoupling of this yen carry trade. So I feel like I saw an article. I posted an article today saying there's a warning that it could be another episode of carry trade unwind, but they seem to be uncoupled right now, and it seems that the main driver is now back into the Fed liquidity in terms of both the yield and equities. So I'm really wary of this liquidity further dropping. And I think beginning of last month, JP Morgan wrote an article saying that this liquidity will get worse because RRP reverse repo levels is likely to go up, and the TGA, which is the Treasury General Account, is also likely to go up, which both negatively affect this picture. So before I get into the seasonality, so just to run that up. So the signs I'm seeing in the market where it points to yields turning up. And I just want to go to my spreadsheet for the moment, because we have a lot of trade setups like TLT, TLH, which are the Treasury ETFs, Bitcoin. We have NVIDIA early in the day. So we have a whole section in the Google Sheet now, which you can check what are the live trades I've alerted the group to be going on, and what are the trades to watch. And if you go further right, I basically update these notes daily. I look at the charts and write notes daily to say, okay, where we are. And the supplement notes have the shorter time frame charts, which kind of support our thesis or point to potential outcomes. Over here is a positioning in terms of, if you were positioning the trade size according to your stop loss, this is what your position would look like if your stop loss has a dollar value of 1,000, 2,000, 3,000, etc. I just want to point out that there's a couple of things I want to say, is that when I have set up some watch, which has, let's say, entry as 163, it's now 162. This is not an absolute. So I could rest an order to say coming at 162 or 163. But because the chart moves so much, there's so many moving legs, I very rarely actually rest a fixed order ahead of time. What I do is I would have an alert to say the price has crossed this region, and I look at the chart again to see if nothing's changed, and I would pull the trigger. But it doesn't mean I would automatically enter 1.163. And by the time I check the chart, it could be 164, 162, and I'll make that decision. So it's just something I want everyone to be aware that this is not a fixated number. It's more like the region I'm looking at to enter. And then these would be the target and invalidation levels correspondingly. And this is risk reward ratio. If you're employing the target and stop loss at those levels, I prefer those to be above 3. And yeah, so this is really, I think a lot of people have found this section quite helpful. This section will get more complete, or I might change things up a little bit as we go along. The last thing I want to do is make this really robotic, like this is the end all be all for every trade. But at the same time, I want to be as precise as possible. So I'll figure this out as we go along, and I welcome any feedback. We already have ETF trades for Treasury yields already, so it's worth checking those out as well. So coming to seasonality, and I will look back to the yields in a second. So September seasonality for equities, generally not very good, and I think everyone is aware of this now. Again, this is a new tab on the in the Google Sheet that is available to everyone. I'll post this monthly so you can see on which days of the year, of the month, the equity market tends to be weak or versus strong, right? And obviously we don't trade on Saturdays, Sundays, but it's the date that matters. So if the market was open on the 7th of September, then this was the performance. We can see that if you include all the years from 1999 onwards for 1996 onwards for SPY, 1999 for QQQ, and 2000 for IWM, we have usually a weakish beginning of the year. Beginning of the month. The market tends to bounce going into after non-farm payrolls and around CPI and after CPI, and we have quite a weak reaction after FOMC. The FOMC is not always on this date, but it's around this time of the month. It's always on a Wednesday. It could be slightly earlier, it could be later. But after the 18th, which is also the expiry, so I think the 20th Friday is also the expiry dates for options, equity options, as well as interest rate futures. So around this time is very weak generally. So September is generally not very good. You can check out each individual dates. I just also want to highlight that in election years, the first week is very, very weak. You can see very big declines in the first week. We probably felt that today. Also, second week, not very good. And then it bounces a little bit in the middle of the month. Again, not very good, generally speaking. The caveat is that election years is only a quarter in terms of sample size of these all years. So since, let's say, 2000, we've only had it was 6 elections. So it's not a big sample size. And what I've added more recently is what has S&P 500 done after the first rate cut since 2000. And I've put that into the spreadsheet because we're definitely getting a rate cut. So I'm confident to put that into the spreadsheet now because we're definitely getting a rate cut this date. It's just a matter of 25 versus 50 basis point. So it's worth watching your positioning around these dates. The first 10 days will be very tricky, both in terms of seasonality as well as the impact of the first rate cut. And the market tends to bounce towards the end of the month. But it's just worth watching those 10 days or 1 week to 10 days or so. It might be worthwhile just reducing position or taking some profits going into the FMC essentially. So for S&P, generally August is weak and September is weak, and then we have. So this is all years, including election, but not just election years, but all years. We have strong October, December, and then into the new year. I just want to show you that this is how it's visualized. So this month, week beginning, going into FOMC, there's a bounce and then quite weak afterwards. QQQ, again, very weak for September, and then strong bounces in October onwards. Again, for going to FOMC, it seems to be quite weak all round. Pretty bad first week, little bounce and pretty bad afterwards, down 3% or nearly 4% from here. RWM again, very weak, going to FOMC, a bounce into the mid-month and then pretty bad decline afterwards. So this is a bit I've spent quite a bit of time sorting out. We have S&P 500 reaction after the first cut since 1990. So I think we have 7 rate cut cycles, including the one that's before COVID, 2019, during the trade war. So I count the trade war cuts versus COVID separately because they were separate drivers. So generally speaking, the first 3 months is pretty challenging in terms of median and average. There are some good years and some bad years. We'll go through them in a second, but the first 90 days generally very challenging, right? And so coupled with the election year, and especially if you look at the first month or so, it's pretty flat to negative essentially. And I just want to point out what we had is that we have rate cut cycles here, and we've had 4 recessions. So not every rate cut cycle is the same. In some rate cut cycles, like the one in 1995, 1998, we actually didn't have a recession, and it makes a big difference. In the years we had 1990, 2000 dot-com financial crisis and COVID, generally speaking, S&P 500 after the rate cut are much worse, and you can see here. So if you look at the lower half of this graph, the worst performing years, 2020, 1990, 2001 dot-com, 2007, right? The market didn't really recover after 90 days. Whereas in the other years, 1998, 1995, and even 2019, the market did recover after 3 months, right? So there's a divergence. So not every rate cut cycle is the same. If the rate cut cycle is accompanied by a recession, soon after, we get a pretty bad reaction in S&P 500. And right now it's a bit conflicting because GDP in Q2 was very strong. So it doesn't seem like we have a recession, but we're having economic indicators saying that recession is around the corner. So we have to be super wary that not all rate cuts are good for equities. It's really macro dependent. And I don't have the perfect answer right now because the overall picture is very complicated, but it sets up a perfect good context for us to operate. And just be wary that if we do have a recession coming around, then these are the paths that S&P 500 might follow, most likely to follow. So this is the 180 days. Again, you can see, so the previous chart is 90 days, this is 180 days. The difference is still big, very big. In the recession years, apart from 2020 COVID, the other years, market didn't even recover after 6 months. Whereas if you didn't get a recession, it's pretty good after 3 months, essentially, into 6 months. You get pretty good returns. So this is where you get the big variance in cumulative returns from. So the volatility of the market is very big in the first few days of the cuts. You can see these are the best performance and worst performance after the first rate cut into the number of days. The variance is huge in the first month, essentially, and slowly it narrows down over time. So just be cautious in late September and early October. So now moving on to bond yields. This is what I'm talking about, looping back into the yields. Generally speaking, rate cuts are bullish for bonds, i.e. yields lower, bond prices higher over time. So especially in the first 10 days. this is the cumulative change in basis points, right? It's not a daily change. So actually, what you get is a lot of volatility going ahead. So it's going into the first month, and sometimes the bond yields are even positive after 1 month. But generally speaking, we're getting the yields are trending lower after month 1 and into 6 month time. Again, just caveat here. So in 2020, 2017 financial crisis, and 2001 dot-com bubble, bond yields were substantially lower after 1 month. And in the other years, so 1998, 1995, non-recessionary years, bond yields actually even rose and pretty much came in back to flat. So overall, yields go down, but it can go up after first cut. It really is context dependent. And I think just translate this into today, right? So what does that mean today? If the market smells recession coming and the Fed starts cutting, we can pretty rapidly expect the market to not just price in, 25 basis point this meeting, 25 basis point next meeting. It will be 50 basis point meeting after meeting, and the entire yield curve will drop lower. So terminal yield at the moment is 3%. That might even drop to 2% or 1% if we smell recession coming, right? But if we don't have a recession coming, the economic indicator is still coming in strong. Let's say the unemployment rate in August, we saw at the beginning of August, was a temporary blip. It was transitory. Labor market coming to strength again, and then we might follow this path. And what is going to happen? So translate that into the FOMC meeting is that Powell is going to say, yes, we cut now. We don't want labor market to soften further, but we are not going to follow a predetermined path of cutting rates. And what you can see is the dot plot, going from 1 dot cut to maybe 3 cuts this year, or maybe even just moving to 2 cuts this year versus the 4 that's priced in, and a much shallower cuts next year. So instead of 200 basis point for next year, we just price in 75 basis point for 2025 of cuts. So from FOMCs, we're going to see bullish as in bullish for the economy tonality from the Fed, saying we're not going to follow a script, taking data by data. If data worsen, we'll act swiftly. If not, we're going to just we're not going to rush into lowering the rates. And there's an argument that because we're still in all-time high after having the highest interest rate increases, the fastest interest rate increases in 20 years, 30 years, maybe financial conditions are not that tight because of the fiscal spending we've seen in the past 2 terms, President 2 terms under Trump and Biden. So the US racked up like $14 trillion of debt since Trump was elected. So that fiscal spending has translated to high neutral rate potentially, and therefore financial conditions are still quite loose given how the risk assets are performing. So that would be something the Fed might want to fall back on as an argument, not to rush into cutting rates aggressively. Again, so just now with the 90-day chart, this is the 182-day charts. Generally, yields are lower, but in 1998 and 2001, even actually, that's a bit surprising, but yields did come higher after 6 months, by the end of 6 months. So this is the final chart for today. Again, this is a macro picture. So the 10-year, 2-year spread, which you can see, which is the early indicator for yield curve inversion. That spread has been inverted for a long time. So essentially since 2022, as you can see. So this purple line is 0%. So it means 2-year bond yield and 10-year bond yield are at parity. So if you think of a normal interest yield curve, it should be sloping upwards. So the 10-year bond yield should be higher than 2-year. Ahead of recessions, usually the bond yield. So when the Fed starts hiking rates, the 2-year yield starts increasing, and the 10-year yield doesn't increase as much. So they fall into parity, and sometimes the yield curve inverts because the market expects the Fed to be cutting rates soon, and therefore the future interest rates will be lower than today. You get yield curve inversion. The point I'm trying to make is that when the yield curve normalizes, we often get a peak in equities, and usually we get turbulence in the stock market. And you can see here, so 1998, the yield curve inverted, touching zero, and then it tried to normalize, and the equity fell. So when the 10-year yield went above 2-year yield, equities fell. So we saw a peak here. Again, in 2000, dot-com bubble, the 2-year yield, the 10-year yield started going higher than the 2-year and start normalizing. We saw peak equities here. In 2006, and then again 2007, we saw the normalization leading to, at least this was a temporary top, and then there was a very big top in 2007. Again, 2019, we had yield curve inversion, and then it normalized straight away. We had a top soon after over here. Well, that was actually COVID soon after. But even before COVID, we always knew that the market was going through a topping process because of this yield curve inversion. So now the 2-year yield, 10-year yield is actually only 4 basis points below 2 years, so it's going to normalize very soon, and that could be a warning sign for equities. It might not be the top tomorrow, but it looks like quite soon after we'll get a very big correction. So that coincides with the first rate cut and then September seasonality. So it makes me leaning towards bearishness in the second half of the month. So now, does anyone have any question before I'm moving into charts? I will talk more about the bond yields as well in the charts. But so far, does everything make sense? Has anyone got questions?
Quick question.
Yeah, sure, yeah.
I'm just curious to know if you think there's anything to do with the holiday, like between the volume that we saw, on Friday and the volume we saw today. If you might be able to talk a little bit about that.
So I think, so I think that's so I think the most relevant graph for that would be, so I would actually point towards here. So the holiday essentially has coincided with the end of month as well. So what normally happens at end of month is that companies need to have certain dollar position or certain balance on in their month-end accounts, and they would essentially start borrowing dollars to make sure their corporate accounts look all right towards the end of the month. And this is not just corporates, like life insurance companies, etc. So the month end, usually there's a funding cost spike, and you can see here as well towards the end of July. So funding usually gets more expensive towards the end of the month, and especially during ahead of holidays. I haven't done the charts here, but I've done analysis while I was trading in a bank, where the dollar yields tend to go up and the liquidity tend to dry up before the holiday, because no one really wants to leave a big position for 3 days, especially when London, so US is closed, but London is still trading, right? So things can still happen. London, Asia is still trading, things can still happen. So there's definitely that effect of people not wanting to have hefty positions going into the long weekend, and the funding costs going higher, therefore putting risk assets under pressure. I definitely think there is this effect. But generally speaking, also August, beginning of September is a holiday month, holiday time as well, and volumes are thinner. Let me just pull up the parts here in my trading view now. So yeah. So I mean, we had a big volume here, but to me, the volume has been average. Actually, it's not that bad. I think this in mid-July was much worse. So I can't really from the equities trading volume, it seems okay, but I would say from a funding cost of funding perspective and liquidity perspective, markets tend to be much choppier around this time. Yeah. Does that help?
Yeah, I was thinking it was because people were back from vacation or something, and trying to see why we didn't see a bigger change or more of a notice on Friday that we were going to see such a big day today. I don't know if anyone could have seen it coming.
I think it's a really good tip. So I'm gonna do an analysis for holiday seasonality as well, actually. So I'll write that down in the chat, and I'll have to come back to you on that, because without actual like data, I can't really. I don't want to make up an answer on the spot. But I will hopefully come back with charts this week or next week, and we can revisit them in the webinar next week.
Thank you.
Okay, great. So just coming into the live charts here. So we still have a setup going at the moment. So I think the fundamentals point to, so we talk about, so just to recap, we said non-farm payrolls has a danger of coming better than expected, therefore yields can become lower, which is bad for TLT. But from a technical and also the liquidity issue as well. And we can see that the liquidity on Friday the 30th essentially drove this big fall in TLT price and big, so big jump in yields over here on that day here. Basically, the market has reversed it today, so it does make me feel like maybe that was just all of that was just the month-end dynamic. On a technical level, the trade has not broken yet. I wouldn't say this trade is invalidated until we breach wave 4. But if we did breach wave 4 after non-farm payrolls, then I have to reconsider this chart altogether, because it looks like just 3 waves up. This is way too short for 5 waves. And 3 waves up essentially indicates that the longer trend, the main trend is still pointing down. But in the absence of that, on a technical level, I'm still expecting us to reach 102 as a minimum target in wave 5. So on Friday, if the non-farm payroll comes worse than expected, of course, we're going to push through that. If it comes better than expected and drops below this, I will stop out of this trade. But anywhere in between, I will leave it and wait for CPI and FOMC to decide. If it drags into FOMC, the chances are, actually, it's quite hard to say right now. But yeah, so I'm still bullish on this in the short term. And what could happen is that we get to this target and get into FOMC around this target, and Powell says, we're not in a recession, we don't see recession coming, we're going to be data dependent, and dot plot prints, let's say 2 rate cuts for 2024, and the market reprices the entire yield curve higher, and we see a big retrace here, and that is normal because after 5 waves we expect a ABC correction down here, and that's my base scenario at this moment. But yeah, again, like non-farm payroll on Friday is a bit unpredictable. I'm still sticking with this trade until I see a broken either here or reaching the target. Same as TLH. And I just want to say that sometimes the fundamentals and price action. So first, we're predicting the fundamentals at the moment. So we don't really know where non-farm payroll comes in, but it's still useful to when the fundamentals price diverge, or if the chart is pointing up and the fundamentals are still pointing down, it's just very useful to know what could drive the price action around the key events, and not to be too stuck around the chart, because at the end of the day, this is an interpretation. Technical analysis is subjective interpretation given what we see in the market. And I'm not always right. This is what I think is most likely to happen. But if unemployment rate comes lower and this chart breaks in my days, I'm very quick to change my mind and start reinterpreting this chart to say, okay, where things are going. So that's how I reconcile the fundamental and price action. I don't think they're contradictory. It just gives us a more holistic view of the market context. TLH, which is short term, which is the 10 to 20 year, is not really, it's mid curve treasury yield. I'm expecting the minimum target to be 112. And the difference between the two ETFs is essentially duration. TLT has a high duration, therefore the price of TLT reacts more towards interest rate changes of its underlying holdings. So if the entire yield curve shifts in parallel, right? So it's not like if the 30-year yield moves more than the 20-year yield, then those two ETFs would perform differently. But let's say they move in parallel, then TLT will move higher in a greater magnitude. So that's the difference between the two ETFs. And I think TLT is more popular because of it, but you have to be aware there is a curve risk between the two. TLT, you're playing 20 plus year treasury yield, so the underlying holdings have average maturity of 26 years, which is much longer than the TLH. And in the longer run, if the deficit problem, the government deficit problem doesn't get resolved, if whoever gets in the office still issues way more debt than the market can consume, then the longer end of the yield curve will come under pressure, meaning yields higher because there's too much supply. So I just want to make that distinction that, okay, you can benefit from the price rise of this more, but there is a curve risk. So moving on to, so actually, just because we talk about yields, does anyone have questions about everything we've talked about before I wrap up on interest rates? Hopefully, like the fundamentals and the technicals give you better, like a more rounded view of what might happen altogether. All right, moving on to Bitcoin. Bitcoin is a popular ticker. So I just want to start with a bigger picture here. The bigger picture is that we have a trade in place from 57.7K and it's still live. It's retraced a couple of times. My primary expectation is that we have finished wave 4 correction here, and we're moving towards wave 5. Wave 5, larger degree wave 5, and we are now in wave 3 of wave 5. There is a risk that the wave 4 is not done, and we're actually in a double 3. So a double 3 is a more complicated pattern, a corrective pattern in Elliott waves. It's not as common as the simple, the ABCs. So it's essentially ABC correction connected with another ABC correction here. So there's a risk of wave 4 being lower here, and that would still be within the larger degree chart of points. That would still be 0.618 retracement. It will be a retracement, but it still be 0.618 extension of wave 1, and that's still a valid support area for wave 4. So there is a risk here. I don't expect this to be the case. I have seen people making a case for lower lows, but if this is the case, we still have a stop here, which is the previous low that I assume to be wave 4. And I think it's really important to have this stop, because if we break below this, it's very bearish, and we might just save us, 20% down here. You can always, wait for this chart to finish down here and resume buying, right? So I think we're being protected by this stop, and I think this stop is very important. Just zooming onto the near-term chart. I see this as a 1-2 and 1-2 setup over here. And it hasn't been an easy ride, but the recent low has not breached this previous wave 2 low. So we've had quite steep corrections here, but just zooming into the 10-minute chart, we've got a 5-wave sub on the 10-minute chart from the previous low and the ABC down. So previously speaking, we just never quite got this 5-wave sub from either this low, ABC, or this low ABC, or this low, which never really quite got the 5-wave sub. So up until this point, I wasn't really confident that we've got a bottom in place. This is the earliest sign. We've got 5-wave subs and 3 waves down, which means the main trend should be up. And on the micro level, we should see, so I really want to see Bitcoin above 60K and then complete 63K at least to resume the upward trend. It's a very whippy asset, so the chart can change quite dramatically, as we saw here. Going to last week, it was very bullish, higher highs, higher lows, and all of a sudden it just dropped. So we should always, I would always have a stop in place, and I would always reassess the chart if it doesn't go against my expectation. So far, I'm still expecting the uptrend. And if it is, if I am wrong that wave 4 is not done here, I'm protected by a stop. Going on to gold, we've said, so it's very close to wave 3 target. Actually, I think the wave 3 is probably done here, given where we are. So we could expect a retrace for gold here. And I think an entry around this level, looking for wave 5, is a potentially very good setup. September is seasonally weak for gold, especially after Jackson Hole. It has been okay since Jackson Hole, but I expect a weakish month. So I'm essentially waiting for gold to start retracing to wave 4 so we can have a trade set up to wave 5. Nothing at the moment. I haven't put a trade setup. I don't think I've got trade setup in the sheet, but I think it's too early to put that in yet. Silver, I think we'll have 5 waves up, 3 waves down, and we'll have a 1-2 correct, 1-2 setup here for a larger. A 1-2 setup here for a larger degree, wave 5. And essentially, this is to play catch up with gold. So we had a sharpest drop today. I just want to zoom into this, into 10 minutes. If I can see the chart. I know some of you have asked about silver in the chat today. Wave C here, wave 2 here can go as low as 24.89, but at the moment it's sufficient. What we want to see is, again, 5 waves up, 3 waves down to say that, okay, it's starting to progress towards the green circle wave B 3. We already actually over here we already had a trade set up over here at 26, and the stop is 24. If we break below 24, then that makes me rethink about this whole chart, where the wave 4 might end. Moving on to Tesla, I think JS asked on Friday whether we have a chance to shoot over 230. I'll restudy the chart entirely over the weekend. What seems most plausible right now is a leading diagonal. The leading diagonal is usually in wave 1, at beginning of wave 1, and it can take form of 53535, or it could be in the form of three waves up, 3 waves down, 3 waves up, 3 waves down, 3 waves up. And it seems at the moment Tesla is doing the 33333 structure. He actually has retraced already. So in the chat earlier, I said we're waiting for wave B retrace from wave A. And I think that is the safest point. It actually has retraced today and is in the target of wave B. So if it opens around this level, it makes our trade even easier. But yeah, so I think this is an attempt. There is one last chance to attempt over 230, and it looks like quite good risk reward. So even if it only needs 25% chance, less than that, yeah, 25% chance of working out for this to be profitable. I've set a stop loss here. If it drops below here, then this wave A, I have to really reassess, the shape of this wave A, because this wave B is a little bit too deep. If you want to be even more, if you want a wider stop loss, I think wave 4 lower here is a good stop loss. If it breaks below that, then I think a larger correction is in place, and we can forget about this wave 5. But it's not great risk reward. I mean, I'm just moving it here. So 11 to 3. Okay, so 3 is still, if the market opens today and we put a stop here, we can still have a nice risk reward of 3 to 1, which is good. So I don't mind that. I haven't put this in the Google Sheet yet. I'm just going to wait for the market to open tomorrow and see. And I will put that as a live trade setup if it comes into play. NVIDIA, so it was a very short-lived trade. I think last week we said if it falls below, so before earnings, we said if it falls below 116, I think it's a good area time to enter to play this wave 4 to wave 5. Typically, wave 4 it holds above wave 1 unless it's in a leading diagonal or ending diagonal like we had in Tesla. So that's the difference. I don't really see us being in the leading ending diagonal here, but essentially we've stopped out basically before end of day today, and it's good that we stopped out. So the stop was 108.8, and now it's at 105. So it's good that we stopped out. So when I alerted the trader, it was the trader was NVIDIA was already at 112. So if you stopped out here, you only lose 3%. I've put the trade back in. In the Google Sheet, I've kept intact the original trade, which is 116. So if you enter the 116, you have the order, you lose 6%. But hopefully your stop loss should be $1 fixed value anyway. So what now? So the question is what now? So this pattern has broken, and have we topped? If we topped, well, essentially what we have is an ABC correction here. And the ABC correction, the reason C is over there is at 123 extension of wave A. So if we've topped and we forget about this alternative potential wave 5, the target area would be anywhere between 75 and 84. And then just to move this aside, on a more granular level, I've shared this chart in the chat, by the way, but I'm just redrawing here. It looks like we have we're going to have a 5-way down, because this as a C wave is already too long. So I think we're in the middle of a 5-way down. There could be a potential bounce back to 112 from here. So from 112 from here, but yeah. So the larger trend is down regardless. So I think right now my primary assumption is that we saw a top already. We saw the top already over here in June, and this was a B wave top, and now we're in the C wave down. Just to finish our Amazon and Meta's potential setups, last week we said waiting for a set entry in Amazon with ABC correction here. We got the wave A, nearly where we marked before, and wave B already. So we're just waiting for wave C. I don't want to get too aggressive with the entry, because this month, seasonality, Fed rates cuts, I really prefer not to chase and let the trade come to me. So I think Amazon, I'm already long, but if I were to enter fresh now, I would be just a bit more patient, given the grand scheme of things. And finally, with Meta, I'm waiting for a retracement to play the wave 3 here, with a stop at wave 2 low. We haven't got it. I'm being patient on this one. I don't even mind. I would be happier even if we get something like over here, a better risk reward. But I will let the trade come to me. So all of this is in the spreadsheet, and I'll fine tune the spreadsheet as we go along. I'll add more stuff to it. So please have a play around. I've added tickers, ETH, Ethereum, and GOVZ onto the coverage list. So if you want me to start covering those in more detail, please put your name next to it. But yeah, so that is the end of the webinar today. So does anyone have any questions at this moment before I drop off? Okay, perfect. So thank you everyone for joining today. If you have any questions, you can always ping me in chat, and I will come back. We'll discuss them either in Slack, or I'll come back with fresh material for the webinar next week. Thank you.